The market is on tenterhooks ahead of quarterly numbers from Nvidia. Welcome to Market Insight. I'm Elena Casas. Options traders are primed for a nearly $300 billion swing in Nvidia's market value when it reports after tomorrow's close, in line with previous percentage moves that have followed the company's results. That means the expected move in that stock could dwarf 95% of the S&P's constituents. Well, joining me now to talk about that company and the rest of the market is Eric Lynch of Scharf Investments. Eric, hello. You've said in your notes that anything less than stellar from Nvidia will be punished, so are expectations too high?
Well, Nvidia obviously is a juggernaut, Elena. The last 8 quarters they've beat and raised, but the year-over-year comparables are getting harder and harder. And this last quarter, even though they beat and raised, the stock was actually down 5%. So if they don't do a significant kind of outperformance in this quarter, you could certainly see some downside. But we do expect the company's performance to continue really doing spectacularly well.
For how much longer, though, can Nvidia be the AI juggernaut? Companies are trying to diversify away from its chips, aren't they?
Yeah, it's a great question. On this quarter, Elena, pretty high confidence it should be a good one. Why do we say that? Well, the read-throughs are quite positive on this earnings season to date, whether it's those that are purchasing the chips like Meta and Alphabet, who are raising their guidance for CapEx going forward, or it's the manufacturer of the chips from Taiwan Semiconductor. The fact that management has already indicated they've already pre-sold all of their Blackwell production expected for 2025 are all good, positive harbingers. So that's probably no concern. But your question is the question, Elena, because what happens? Does this thing turn into a pumpkin? One of the fears that we have is that the vast majority of compute that's been spent so far on these generative AI chips is in training these large language models. Very limited so far in terms of usage of inferencing. So we'd love to see some visibility in the quarter going forward from the company on who's really using this stuff and how's it being deployed. We're getting anecdotes, but we'd like to see much more than that.
What about the tighter financial environment as rates have risen? Is that going to mean some of the AI trade is unwound?
Yeah, I view this as kind of a macro versus micro event tomorrow in a report, Elena, because in the last month, you've had this surprisingly strong, at least U.S. economy, that's bid up the U.S. 10-year about 40, 50 bips. And so that's pressured some of the kind of more speculative areas of the market. The Philadelphia Semiconductor Index is actually down 9% the last month. IT has generally lagged the broader market. And so it'll be interesting to see if the unbelievable engine of Nvidia can kind of, outperform the micro pressures on valuations.
Today and yesterday, we saw some more generally defensive moves in the market amid concerns about geopolitical and trade tensions. Is it time to rebalance portfolios, do you think, to a more defensive stance?
It's probably prudent, Elena, because we've really had a risk-on market ever since the pandemic started. If you think about it, we've entered this, exceptional environment from a macro perspective where countries around the world threw trillions of dollars of stimulus into their economies on a fiscal basis, but the monetary policy was also very loose. So together, that obviously juiced inflation in the economy, and it put a risk-on element to the marketplace. And so if you were to break down the S&P 500 by factor returns since 2020, the momentum factor has wildly outperformed everything else. It's up 130% cumulatively. Low volatility is only up about 40. So if we're going into geopolitical risk, trade risk, higher elevated kind of interest rate risk, all those could pressure valuations. And yes, you could be seeing an opportunity here to get more defensive and get actually better outperformance going forward.
And where would you be looking for those defensive trades?
Yeah, one of the areas would be in what I would call, we would call kind of defensive financials. If interest rates are going to be higher for longer, let's say you're an insurance company and you're selling premiums for consumers and businesses, you're redeploying that premium revenue into oftentimes fixed income, and i.e. interest rates that are paying higher yields. So that's a little bit less risky than, let's say, plowing all your money into banks, which are kind of more at the mercy of the economic cycle. So that's just an example. Getting into areas that could benefit from these different conditions we've seen in the last 20 years, but also not getting too far over our skis because of some of these macro risks that we also see on the horizon.
Eric Lynch of Scharf Investments, thank you so much for that analysis. And that's your market insight. Don't forget, you can watch more videos on Reuters.com.